this DTI so I can show you guys how to use it. Here we go. Here we are. So very simple calculator. Hi, welcome to my channel. You guys are ready to learn? I'm out there provide you with some inside secrets. These are secrets that the banks don't want you to know. And what is that secret going to go ahead and be? Debt to income. Well, in your mind, you may be thinking that you understand debt to income, but as a person that approves loans for a living, let me tell you exactly what they look for when they look at your debt to income. And if you stay towards the end, I'm going to provide you with the tools for you to be able to calculate your own debt to income at any time. So stay towards the end to go ahead and learn about how to get access to that tool. Again, my name is George. I am a consumer loan or credit analyst, which is pretty much I help people get loans for a living, and I help people build or rebuild their credit. So if you need help, that'll be somewhere on the screen here. But let's go ahead and hop into it now, and let's get you learning so we can get you guys approved for these loans. Okay, so let's go ahead and start off with this. I'm very excited. So this is a nice little slide I did for you guys. Let me slide on with you guys. All right, here we go. So what is debt to income? So for the people that don't know what debt to income is, it's pretty much a formula that is used to determine how much of your income is going towards your debt, which then is a tool we use as consumer loan underwriters to see if it fits within the lending policies of the financial institution, whether you're going through a bank, a credit union, or a financial institution like a Capital One or maybe a One Main Financial. That I know that they've started to expand more of their financial reach. So that's essentially really what a DTI is. Really nothing really much, as you can just see here. It's just a measure used to compare how much your monthly gross income before taxes goes towards your debt. You know, potato, you get it. You guys got it. All right. So we're gonna go over my credentials. Obviously, I didn't do it in the beginning of the video because I wanted to go ahead and save it for here. So let me go ahead and go over my credentials so you guys know why I am qualified to go ahead and assist you. So let's go ahead and start. So this is me, credit counselor, my certification for credit counseling. Next one is going to be my certification for mortgage underwriter that I received. This is another mortgage underwriting certification, another mortgage underwriting. This is where I've worked. These are places where I've worked as a consumer loan underwriter and a mortgage loan underwriter. So, okay. So yes, so this is the table of contents of what we're going to be going over today. So this is all that we're going to go ahead and touch. And again, towards the end, I'm going to go ahead and make sure to show you guys how to get that debt to income calculator. So let's go ahead and get started. Okay, so the first one is going to go ahead and be gross versus net. So what to tell you about this and how this ties into your debt to income. Depending on what you select on your application is what is going to determine the pre-approval, which is pretty much the beginning decisions if we're going to give you a loan based off the parameters and the information you placed on there. So making sure you place your gross and your net. And maybe you're thinking to yourself, what is gross? That sounds gross. It is gross. No, it's not. So gross is pretty much everything you earn before taxes and your deductions are taken out. So that means like your 401k, maybe your health insurance, dental, vision. That's all under your deductions. Obviously, then you have your taxes, right? So essentially, you have your gross income, your taxes and deduction, and then your net pay. So net income is pretty much essentially what you take home after each check. So that's pretty much what gross and net is. So again, making sure that you put gross always what you take before any taxes are taken out. All right, let's move on forward to the next. Okay, not all debts are considered the same or counted the same. So essentially, what do I mean by this? So it's just not measured about what's on your credit report. It's also measured on if you pay child support, if you pay 401k loans, if you pay did I say alimony? I must have said alimony. No, I said child support. I'm locked in, guys. I'm locked in.
I'm moving different. This shit ain't nothing to me, man.
Yeah, so alimony, any any government loans or fines that you owe, like all that becomes a factor into your DTI. Why? Because you're obligated to pay that. Come on. That is essentially why. So, just a little bit of what I got here written. Essentially, medical bills are not included in it. Utilities, your subscriptions, your car insurance, your grocery bills. It's not about what you owe, it's about what you're obligated to pay. So it's like how I said, so all those things, so child support, alimony, 401k loans, any garnishments being taken out, any government loans or government fines that you need to pay, IRS debt, that all will need to be counted towards your DTI. Here's the secret. Don't tell anybody, but if they don't find it, you don't got it.
Low kick.
You ain't hear that from me. You ain't hear that from me. But anyway, let's continue looking at this. Okay, so again, went over medical bills, utilities. So that's essentially it. So these are debts that are outside of your credit report. These are the ones that will count. Okay, let's move. Okay, and hidden debts that will sneak into your debt to income. Here are a couple. So your student loans, if they're in deferred, we will use 0 to 0.5 to 1%. So all you gotta do is, if you don't know how to do this, you essentially just grab how much you owe as a balance. So let's say if you owe $10,000, you do times 1%. That will come out to $100. So that's how much you would charge. That's how much your monthly payment would be on your loan application that we would do. And I did 1% just because it's really easy to do that. But most lenders will use a half of that. So that would be 50%. Other things, cosigner. Oh my God, that is something that people really fight me about. Is that, oh, I'm a cosigner. We don't give a shit. You put your name on the document, you're gonna pay for it.
You need to leave.
You paying for it too. The cosigner does not take you away from being responsible for the loan, because that's the whole point of you being a cosigner. You're there in case the primary signer can't pay. Oh God.
Congratulations, you played yourself.
Duh. So to all you people that don't believe cosigners, that's why you guys have gotten declined for loans. The only way around this is me. Look, lock in. If you're new to my channel, subscribe. Ooh, I'm about to give you this game. Here's a way around it. A way around it, what you could do, not every financial institution does this. This is more in the mortgages because it's an actual rule. But when it comes to getting autos, personal loans, motorcycle loans, pretty much a loan that's not a business or a mortgage, essentially you can ask them, hey, if another person is truly paying on it, will you guys accept 10 to 12 months of proof of payment from that person? And that is the only way that it can be excluded. And again, it varies from lender to lender. Out of like 7 or 8 lenders, I think where I've worked at, only 2 of them have. Well, no, I'm not counting the 2 full mortgages from consumer. Only I think one of them, which is where I'm at right now, actually allows you to exclude those. So that is something to keep in mind. We already went over this: your child support, alimony, garnishment. And like I said, you might think a cosigner loan isn't yours, but to us, the credit analyst, the bank, yes, it does. Okay, let's move on.